Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to another episode of Real Estate 360 Live. For those of you not familiar, we do a weekly podcast. We were broadcast on CBS for close to 3 years. We moved to a national platform. You can download us directly from iTunes. If you go to the iTunes store, type in Real Estate 360. You can subscribe there. You can download the weekly podcast to any MP3 player device you have, whether it's Apple. And also, if you'd like to just stream it live and direct from the website, you can go to realestate360live.com. That's realestate360live.com, and you can stream the show live. We've got all the past shows up on there. There's also, on that website, there's an Ask a Question button on the right-hand side, which is where I direct everybody for any questions that you may have that you want us to cover in future episode. We've had a lot of good questions lately in regards to just, buying homes and issues that come up with credit and mortgages, and kind of, best practices if you're looking to buy, sell, invest in real estate that we can help you answer. As many of you have already noticed, our show is not like a traditional real estate show where we're just going to sit here and hype real estate up and say why it's such a great time to buy a house. Obviously, interest rates have been low for quite some time now, so it has been a very conducive environment for people to purchase homes if they're willing and able to, if they have a secure job, if they've got a down payment saved up, if they've got reserves, that they're not worried about the future and taking on a bigger mortgage payment. What we are going to talk about is everything from interest rates to the economy, to what's taking place in Congress, to what the Federal Reserve is doing by pulling back their purchases, or what we've called a taper of their quantitative easing. On the most basic level, we have assumed for a long time by them pulling back their stimulus that mortgage interest rates would rise. As we found over the last couple of years, that every time that there seems to be something that's going to shoot rates up, we've got sideshows taking place, such as Russia right now, where anytime there's global instability, we've got a lot of money that's being pulled out of the bond market, or actually out of the stock market and put into the bond market and mortgage-backed security market as a safe haven. Bonds are always considered a safe haven in times of global turmoil, so that's where the money has been flowing. So we want to help you understand the macro scale of what's taking place out there in the world and how these things can affect you in your real estate decisions. Joining me on our panel, as he does each and every week, is Louis Camarosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. Louis is often cited in the media as a real estate industry expert. He's been in the Wall Street Journal, Forbes, Fox, U.S. News, CNN, MSNBC, and numerous others. Louis, how you doing today?
Doing splendid, Ryan. How are you?
I can't complain. I think that I'm hoping that we finally have made it to the end of the snowstorms here, which is good for reasons. It's good because I don't like the snow, and B, maybe the Federal Reserve and Congress and everybody else can stop blaming the snow for all of our economic issues. So we spoke a lot last week about the Federal Reserve and the implications of what they're doing. They had another taper of $10 billion. You and I discussed that basically it was a net wash because they keep reinvesting all of their, the initial stuff when it comes back. They're putting it back into the pile there. So we're not really seeing major upticks in mortgage interest rates. Now, there's been some this week. Some of the economic news we had, GDP, the fourth quarter has finally been revised, raised from reading of 2.4 to 2.6. The market took this as generally good news, but really not that much of a reaction because it was widely expected to hit that 2.6%. We had personal consumption expenditures on a quarter-over-quarter basis at 1.1 versus 1.0. Core PCE 1.3 versus 1.3. A lot of these were basically right in line. The initial jobless claims for this week were better than expected at 311 versus 325. And as you and I talk all the time, Louis, okay, 311 versus 325, is that something we should jump up and down about? Well, the markets jump up and down about these little things, even though they're not great numbers. They're terrible. They're terrible.
1.2 million people losing their jobs and applying for benefits each month.
Absolutely. I mean, and if we're not seeing substantial decreases, instead of like 311, this should be going down to like 250. And
coupled with growth on the non-farms payroll,
correct,
which we're not seeing.
No, we're not seeing any of that, which, you know, to me tells the story that this economy is a lot worse off than anybody in the media wants to make it seem.
Well, Ryan, look at the GDP. Now, it was revised higher, and it was on an increase in consumer spending, and you would say, okay, that's good. Consumers are confident. They're spending money. But you know where the bulk of that came from? Increased health care costs, which they include in GDP, which really should be an expense, right, and increased costs on gas and electric bills and utilities. So basically, the economy gets better when we're cold and sicker. It doesn't
right.
make a stitch of sense that people don't even notice that consumer spending makes up 70% of the GDP. If people are paying more money for things that they're forced to have, like health insurance, or that they need to have, like home heating and electricity, that's not increasing production. It's called, you know, there's not any benefit. In fact, it's a negative that people have to pay more for health insurance and to heat their homes. But yet, as part of the narrative, well, the GDP is growing because consumer spending is growing.
Right. Yeah.
And by the way, excuse me, but the cold weather actually helps. They've been blaming the cold weather on our economic woes when it's actually boosting GDP because people have to heat their homes and pay more money to do so.
I was about to say, you can't have your cake and eat it too, right? You can't blame it on one end and then on the other end hype up the data because it's leading to a higher number, right?
I'll give you another example, Ryan, on how they do that. If you look at what's happened in the housing market, home prices decline, they blame the weather. Existing home sales are down, they blame the weather. Mortgage applications are down 18% year over year, they blame the weather. You know, is it too cold to apply? Pending home sales are down 8 months in a row, they blame the weather. I thought the weather just started getting bad the last 3 or 4 months. But here's the one. New home sales are down. And, of course, they blame the weather. Well, if there's this massive inventory shortage, then you would think that new homes would go up irrespective of the weather, new home sales, because people would be lining up to buy homes because of this massive inventory shortage so that home builders wouldn't be able to keep up. Right. Well, that's not the case. Home builders' sales are down even though there's an inventory shortage, and no one wants to admit that the economic woes we have are not a function of the weather. They're a function of lack of consumer demand for houses because the employment isn't there, the wages aren't there, and they're spending more money on health care and electricity, and yet the way they spin the whole thing is, housing will come back just when the weather gets better, the economy's going to do better when the weather gets better, and by the way, the GDP is higher. And that's how they spin this whole thing. And then you bring it over to the Fed, and you got Fed President Bullard saying, unemployment's going to go down to 6% this year. Well, it probably will. As more people leave the labor force, the unemployment rate will continue to go down. And they will spin that as a positive as well. I don't know. I want to get your opinion, Ryan, but how much longer can they blame the weather? And where do you see the economic data coming in later this summer? And will it kind of disprove everything they've been saying, or will they somehow manage to keep spinning that there's a recovery going on?
Well, I mean, I think that, I think they can probably continue to spin that the recovery is going on maybe through this summer. I don't know. It's obviously, if we're talking about some of the major metropolitan areas, like I can talk in terms of what's taking place here in Washington, D.C. So we've got, when you're talking about new home sales, I know for a fact that our new home sales are pretty good right now, actually. I mean, there's actually a lot of people that are running to new home sales now. But where I'm seeing it starting to stall out is these builders get greedy, right? The builders get greedy and they start a price. So let's say that their price was $350,000 late fall last year. Now into the spring, we want to push up to $380,000, $390,000, right? So now all these buyers that are looking at let's just say it was a townhome that they were looking, and they can get a resale between $300,000 and $350,000, but the new home sales are $380,000 to $390,000. Mm-hmm. Well, it makes sense that the new home sales would start to stall out because guess what? They're almost 50 to 100,000 spread difference between, a similar square footage home in the same area. But builders are infamous for, overcharging. You're always going to pay more for a new home. Mm-hmm. You always are. And now, since they're probably in line with everybody else that the economic recovery is on, they feel like they can justify and raise prices up high.
So they're misreading the market, and they're falling prey to the media and the Fed saying everything is better, everything's looking up. So they're raising prices, but they're seeing the demand isn't there when they raise the prices.
And you know what, Louis? What's interesting to me, many of the builders that are building now were the same builders that bought this land, like probably maybe, back in 2008, 2009, when all the prices were driven up. So the reason why they didn't...
I'm sorry, in 2008, 2009, the prices of land were where?
No, sorry, they bought prior to 2008, 2009 when everything went bust.
Okay. They overpaid.
They overpaid, so they've been sitting on this land for quite some time, and they weren't willing to build until they knew that they could get a price that was high enough for them to actually build on it and sell. Well, now we're into that market where most of these builders that were holding that land, now they want to open up developments all over the place, which is what is taking place right around me right now. We have an influx of townhomes and detached homes, and you know what? They're not building them as big as they were before. They're you know what I mean? They're building them smaller so they can keep their costs down there. But they still have to get a certain price in order for it to be profitable for them. And I do think you're right. I think at some point it could be this spring or summer where stuff really comes to a head. I mean, we obviously have interest rates that are nudging up a bit, maybe about 0.25%, and they could go higher. But I think what everybody's finding is that there's not as many qualified buyers out there as they keep saying. The 4 million renters or potential first-time home buyers are not going to be buying these new homes, right? A, because most first-time home buyers don't buy houses brand new, and B, because they're going to pay a much bigger premium to buy those homes.
And isn't credit still tight? I saw an article in the Wall Street Journal saying only the best get mortgages, the best credit scores.
Yeah, credit is extremely tight. And, if we don't even talk about, somebody obtaining a mortgage, but if we just look directly to what's taking place in the mortgage business and how it's really not that profitable, the National Mortgage News came out with an article on the profitability of the mortgage industry. And obviously Jamie Dimon's already stepped out and said that he essentially hates the mortgage business. Well, according to the article, the profits in quarter 4 of 2013 were down 7% from a year ago. Okay, so right there that interest rates had remained pretty steady for about that period of a year,
right?
And the profits are down 7%. So we have compressed margins due to increased competition as well as increased compliance costs were the big reasons for the drop in the profit per loan originated in the fourth quarter. The average profit was $150 per loan, which is the lowest since the Mortgage Bankers Association started doing its performance studies in 2008. The average is down from $743 in the third quarter and $2,256 in the fourth quarter of 2012. And they go on to try to rationalize why it's down because they were willing back in the 70s that they were willing to do loans at a loss so that they could get the servicing rights on those loans and make money there. But I feel like that's actually not what's going on at all. The compliance costs are a major issue because there's a lot of regulations and there's just fines being thrown out left and right. But at the end of the day, there's just not that many qualified buyers out there. They're not getting enough loans done, right?
Ryan, if we are in a recovery and if we cannot manage to get mortgage profits higher, existing home sales to go up, new home sales to go up, mortgage applications to go up, pending home sales to go up, and prices to continue to go up, how with $4 trillion worth of QE and still $55 billion a month if QE being pumped into the system, how are these numbers going to improve when they're on the decline when they shut off QE?
I'm
and they keep saying the economy looks bright, and none of these numbers we mentioned with respect to the housing market look good, with respect to the GDP look good, with respect to employment look good, but yet the Fed is insisting, and the media is going along with it, that we are full steam ahead, we're going to get this escape velocity, we can drop the QE, and everything is fine, as if you can print $4 trillion, get no economic results, and then just walk away from it and say everything is fine. Well, other than the weather, people ask me, why are gold and silver down the last couple of weeks? And I don't tell them it's market manipulation. People are worried about what the Fed is doing in interest rates. I tell them it's the weather. That's the excuse for everything. I don't know how much longer. You're talking to intelligent people, you would think. Every news story I saw last week and this week, either in the first sentence or the first paragraph, when they introduced the housing numbers, mentioned the weather.
Right. It's a lame duck excuse.
But they all use it. MarketWatch, Reuters, AP, they all use the weather. The Fed talk is all about the weather.
So do you think, I think it's kind of actually shows how desperate they are, right? How desperate they are to hang their hat on something that is really doesn't have any relevance. I mean, let's go back to 2003, 4, and 5.
When is the weather going to recover, Ryan? When we get better economic data? Is that how the weather's going to turn?
Yeah, the sun will shine when the economic data comes out and it shows that initial jobless claims are down 50 or 100,000 from the prior week, or GDP is up a whole another percent, or the unemployment rate is down another percent. I mean, those are all things when the sun's going to shine. Until then,
the forecast is for more weather. Since when has the weather had this much of an impact? We haven't had national disasters. I can understand Hurricane Sandy runs up the coast, devastates. They didn't talk about any problems back then about the weather.
Nope.
Well, there you could have. Well, because Keynesians believe that natural disasters and things like that are actually boons to the economy. You get to destroy something that was perfectly suitable, and you get to rebuild it, thereby creating economic activity. So that's probably why they didn't want to blame the weather.
Absolutely. I mean, it's the same thing as when we go to war, right? It creates that temporary economic activity that takes place.
You build stuff to destroy stuff, right?
Yep. Well, I'm curious because, so if we actually were buying into this as a recovery, let's look at, last time when we had house prices shooting through the roof in 2004, 2005, 2006, right?
Mm-hmm.
So do you think anybody at that point in time, interest rates were low, there was a low interest rate environment just like there is now.
Right.
During that period of time.
And there was no QE, though.
And there was no QE, but just think about this. If there was snow on the ground, would there be people lined outside those new homes?
Oh, absolutely. If they had their Liar or Ninja loan ready to go and they were worried about getting priced out of the market, they'd be lined up in the snow, bundled up. Of course.
They would be, right?
Absolutely.
And
they were. It was cold in 2004, 5, and 6.
And I bet you if we look back at what the
we had
weather
winter
was,
then.
Yeah, if we look back in the weather in 2004, 5, and 6, I guarantee you that there were still stories of people that were probably outside in their tents camped out at those new home sale sites to be able to be the next one that could write a contract to turn around and try to flip it 6 months later.
1.4, 1.6 million new homes sold a year during that time period, 2004, 5, and 6. Now it's at 430, 440,000 a year. It's 3 times less, and there's supposedly an inventory shortage, and the builders aren't selling more houses.
Right. So,
how can anyone look at that and say recovery? Well, you know why? Because maybe 8 months ago they sold fewer houses than they sold last month. Exactly. So now it's at an 8-month high.
Yep.
That's how they spin it.
Yeah, and it's really crazy because, like I said, most of the time you can just do a basic eye test and you can pretty much figure out what's going on. Now, this low inventory environment at some point is not going to be a low inventory environment.
It's a low demand environment.
Correct.
Not in the D.C. metro. Remember, for our listeners, in some of these metros like San Francisco and D.C., what we're saying would make no sense to you because people are lining up to buy houses. And prices are increasing. And there is builder activity in those areas.
Yeah, and those areas are also probably they probably have the most amount of jobs in these areas,
and the best wages too.
Yeah, exactly. The best.
Silicon Valley, San Francisco, Washington D.C. metro, people have stable jobs, high-paying jobs.
Yep, you got government contractors, you got people that are employed by the government. There's
Silicon Valley stock options.
Right, and where you have stability. That's where we're seeing, the inventory and more new home sales. All those things are taking place. I mean, this is not, on a national scale, it's not taking place. But, yeah, in the major metropolitan areas, this is what's going on. Now,
hold on. When you say major metropolitan areas, select major metropolitan areas.
Yeah, your New Yorks, your D.C.s, your San Francisco.
Right.
So your let's just call them major hubs. right?
Yeah, I wouldn't say Chicago, though. I don't think Chicago is doing that well.
Well, it's doing okay, though. I don't think it's doing horrible.
No.
You know what I mean? I don't think it's doing near as well as the D.C., New York, and San Francisco market.
Right.
You know, but you know, as a general rule, like where there are jobs and stability and growth, obviously it makes sense for there to be these issues. But you know, all of the equity that's being built up, it's really scary to me because I'm just sitting here and I continue to look at where the stock market's sitting. And I know that, you know, what the Fed has done is just created these huge asset bubbles that are going to burst at some point. You bring up the point. It's like, okay, well, when is enough, right? When is all of this really going to come to a head and you know, they're going to have to change course, and is everything just going to fall and collapse at once? And I think that the Fed's mapped this out. Obviously, you know, you've got the Fed out there talking each and every week, and it seems like they're talking more and more. Is that just me, Lewis, or does it seem like they're out there just in the media pumping more and more information out to them lately?
Since you and I have been doing the show, about once a month, every couple of months, I pull together all the statements that the Fed presidents are making, and generally they're out there once a month, 4, 5, 6, or 7 of them making statements. I think maybe it's just getting picked up a bit more what they're saying because people are paying attention. But that's basically all their job is to go to a meeting every couple of months and then the yak in between about what they said in the meeting or what the Fed might do. So I don't think they're talking more. I think they're talking more gibberish. But I don't think their communications have increased, at least in the last year and a half that we've been watching them. Now, before that, you're right. The Fed didn't hold press conferences, and then the presidents didn't run around shooting their mouths off, but it hasn't increased in the last 6 months to a year.
Yeah, and I think that, you know, they
were backpedaling for Yellen. You know, they're saying, well, it's not just 6 months, it's not a hard stop after QE ends that we're going to raise interest rates.
Right. Did you happen to see that article that was in the I believe it was on Fortune or CNN Money, one of those, where Jeremy Grantham, who is a money manager, I believe for the firm GMO, had called the newly appointed Federal Reserve Chairman Janet Yellen ignorant in the New York Times. It was funny. I mean, he went into great detail to explain why everything that the Fed's doing is just disruptive to the overall economy. It's had no actual meaningful impact. And, you know, he said the reason for the slow recovery was not the severe financial crisis, continued high employment, or the standoffs in Washington. Instead, he blames the Fed for ruining the recovery it was supposed to stimulate. And for someone who believes in the law of economics, it's hard to overstate how that claim is. It's positively bonkers. What's interesting is that, you know, CNN Money doesn't typically like to run articles that would be like anti-Fed, right? So I'm going through and I'm like reading the questions that they're asking. Let's see, one of the questions was, can you really blame the Fed for the bailouts? That was an act of Congress. And he says, and I quote, I don't like to get into the details. The Bernanke put, the market belief that if anything goes bad, the Fed will come to the rescue has had a profound impact on the way people and how they act.
That goes back to the Greenspan put.
Exactly.
Now it's the Yellen put.
And so then they follow up the question with, okay, but that's still not proof that quantitative easing slowed the recovery. So the whole time you could tell that the author, Stephen Gandel, who's covered Wall Street investing for over 15 years, is trying to push him to discredit what he's saying. And then so he continues on that there's no proof on the other side that the economy is any stronger from quantitative easing. There's some indication that the crash would have been worse and the downturn would have been sharper had the Fed not stepped in. But by now, the depths of that recession would have been forgotten. The system would have been healthier, and we would have regained our growth. You and I talked about this, Lewis. It was better for us to suffer for the first 2 or 3 years and just build our way out of it versus, you know, artificially manipulating it for such an extended period of time that we're delaying the inevitable.
But you know why they did that, Ryan? They did not do that. They did not do QE to continue to boost the economy. Because as you say, if they had done nothing, then we would have built their way out of it. That would have meant the banks would have failed. The reason they did QE for 5 years and spent $4 trillion was to boost the bank's balance sheet. And shockingly, as you pointed out last week, when they did the stress test, a couple of them failed.
Right.
And it's surprising. I would think that none of them, as you say, should have failed. They should all be so flush with capital and so able to withstand any downturn because the Fed has basically printed up money, given it to them, and they should be out of the woods, but they're not. So that's why they did QE, not to help the economy, because it hasn't helped the economy. You can only make it, like a Keynesian wouldn't even do this. Well, now the neo-Keynesians would do this because that's what they're doing. But the original Keynesian philosophy was that if the private market was repressed, then government would step in and kind of boost the economy to get it back on its feet again. And then once it was there, and once you had, then you would pull back. They never advocated just permanent stimulating the economy, because if you stop stimulating, it'll die. Right. And that's not what they're doing. Their stated purpose is they're stimulating the economy. Really what they're doing is ongoing bailout of the bank. It's an ongoing bailout of the banks, and that's probably why they're ready to stop now, because they figure the banks are probably in a good enough position. That's why they released the stress test to withstand a crash. So now that we've capitalized them by printing up money, who cares what happens to the economy?
Right. Yeah. Well, and that same article that I was just quoting, so I always find it interesting, Louis. I don't know about you, but I love to go down and read what people's comments are.
Oh, I love it. The comments are better. Sometimes they're much more insightful than what the author writes.
Right. So, okay, so the one guy digs into who this guy Jeremy, what's his name?
I've just pulled it up so I can read along here.
Yeah, Jeremy Grantham. So Jeremy Grantham, I guess, he's the co-founder of money management firm at GMO, and I believe that GMO is heavily invested into the bond market. Okay. And, seniors, and has a lot of seniors' money under management. So, yes, it would make sense that, he would be quite angry at the Fed. I mean, obviously the yields on these bonds are quite low, and as seniors aren't making much money right now, are they? So,
no, that's why they have to go work in grocery stores.
But I really do feel like, the same stuff that he's talking about is the same stuff that you and I have been talking about for three years now. This isn't, we talked about, this stimulus was inadequate and it wasn't going to do anything. Now, what I found interesting in some of these comments when I dug in deep is there were some people that studied economics or were, really considered themselves economists. And they said, no, it's not the Fed's fault. They actually did everything in their power. Congress told them to do this, and then they went out. They've lowered interest rates. They've kept them low for an extended period of time. So even though the recovery's not there, the reason why the recovery's not there is because Congress didn't do their part. The Fed did their part, but Congress didn't do their part.
That's what Fed President Fisher was saying, too.
Right. They didn't take it upon themselves to lower taxes, right? They didn't take it upon themselves to set budgets and to, create jobs through infrastructure and all these things. It's Congress's fault. So, okay, that's fine. So do you think that Congress doesn't know exactly what they're doing? They didn't want to bail out anybody but their buddies, okay? This is a very calculated move on the part of Congress. They weren't going to go out there and, as you said, write blank checks to the entire, United States, right? Which was what you and I joked about the other day. Why don't they just write checks out to everybody? They weren't going to do that. It was going to be it's the whole creation of what we have in this class warfare, so to speak. We have the rich getting richer and the poor getting poorer. And the reason that is because the rich have access to the capital and nobody else does.
And the reason the rich have access to the capital is the politicians and the Federal Reserve make sure it stays that way.
Yeah, they have no reason. They have no reason to want to give, money out to anybody other than them.
If it's required to get votes.
Correct. Yep. So and when you dig deeper into,
and that's not how the government's supposed to work. Is how much money can we extract back from our politicians? I mean, basically, that's the danger and the flaw in democracy. Once people realize that they can then vote themselves a raise or vote to get money for themselves that they didn't earn by having a politician reallocate it to them, then it's all over. And it's not just the poor that do that voting for welfare. It's the rich lobbyists that do it to make sure that the money comes in the way of forms, subsidies, favorable regulation where you only get fined and don't get thrown in jail. And that's basically the problem now. The government's gotten too big. Because it's so big, the politicians are inherently easily corrupted because they can control so much money with their vote. If it was just some little 2-bit town, and there wasn't much money involved and the guy worked, it wasn't a full-time job, he didn't have that much influence, you wouldn't bother bribing politicians. Now they outright bribe them, they have lobbyists. That's their job is to make sure that they get their way.
Right. Yeah.
The Fed is, well, what is the Fed? They're made up, their shareholders are the banks.
Yep.
So too big to fail banks. And you don't think they have political clout when half the people that work in government in the top positions used to work or going to work at these large banks back and forth?
Right.
Even the people that work at the SEC, they go back and forth. They actually call in people from the banks, the SEC does, to get guidance when they're drafting their rules. Well, that's crazy.
Oh, yeah.
How can we make sure that this doesn't really impact your business that much when we regulate you?
Oh, yeah. And the funny thing is that when these big banks, they do get fined, for, $10, $20 billion. It
hires more people to work at the SEC.
Right. But
they use the money to keep regulating.
But the funny thing is the banks already know that these fines are coming, right? When they're sitting down at these meetings, they're like, look, we're gonna have to, make, show everybody that you messed up. We're gonna slap you on your hand. We're just gonna hit you for $20 billion this time, okay? But you made $100 billion, so don't worry about it. You know what I mean?
It's the moral hazard. It makes sense. Crime pays, and it also keeps out smaller banks because you and I can't make a decision to commit that crime because the fine would be too high. We wouldn't make any money on it, and we'd go to jail. So basically, it's a criminal syndicate where, the five families, the five banks are able to commit these crimes, pay the fine, and no one else can step on their territory because they can't afford to hire the lawyers, the regulation, and pay the fines. And they don't know the people in the government, at the regulators.
Right. Yeah. I think it was just, I was reading an article just the other day that a couple of the big banks had asked the Fed if they were able to reinvest or buy back some of their stock, I guess, with some of the dividends that were there, and the Fed said no. So it's like, the Fed can say that they're, not agreeing with the banks on everything they want to do, but it doesn't matter because at the end of the day, they've given them the best thing possible, which is access to basically free capital. Right?
And, that's a setup, too. That's just to make it look like the Fed has them under control. It's the other way around.
Oh, yeah.
Do they really need to buy back their own stocks like their share price isn't going high enough?
Right.
Like they don't have better uses for their money besides paying fines? I mean, they can make more money than just boosting their stock. But the reason they want to buy back their shares, even if their share price is rising, the more it rises, the bigger the bonuses are.
Right.
But again, are they not making big enough bonuses? I guess it's never enough.
Yeah, I mean, it's when is enough in anything when it has to do with Wall Street, right? I mean, they always want more.
There's nothing wrong with that, though, Ryan. If they're producing more, satisfying customer needs more, then they should get more. But if all they're doing is bilking the system to get more, then that's not deserved.
No, not at all. I mean, I'm all for, doing it the right way, but I mean, it's just like, it's the unfair advantage that these companies have,
Right. And that gives capitalism a bad name. They make it seem like, wow, look, when you have capitalism, all these people get rich unjustly. Yeah, they do get rich unjustly, but that's not capitalism. That's working with the government and working with the regulators and buying influence and controlling and rigging the system and really providing no added benefit to consumers to make their life better by providing cheaper and better products and services. They're not involved in that game.
No. And that's why I thought that was, with CNN running that article, it was almost like, they were running it, but they were trying to discredit this guy at the same time. And that's exactly what was taking place. And what I find really interesting is I always look at, okay, how many times was this article shared? It was only shared like 696 times, right? Well, I feel like an article like this should be shared, thousands of times because the guy's actually speaking the truth. You know what I mean? But this is the type of stuff that people don't want to believe. They don't want to believe that the quantitative easing and that the artificial manipulation of interest rate isn't working. Right?
No one wants to believe that their house isn't going to go higher. No one wants to believe that the economy isn't going to get better. So when you say the economy isn't recovering, they call you gloom and doom, even if you're being realistic, because everyone is saying it is, and it's like, well, what are you, a party pooper?
Right.
It has nothing to do with that, but it's really a fine example of mass psychology, how they have convinced people, maybe even the mainstream media isn't even complicit in this. It's just they go along because they're parrots too. They hear it. That's what the story of the day is. so they got to put weather in the first page. I mean, in
Right.
the first sentence whenever they report on economic data. It's just like no one ever got fired for hiring IBM. Well, no one's going to criticize your story if it's got weather in it because everyone else has weather in it.
Yeah, and it seems like weather is the term that's pulling big results in, right? So
right.
if it is, why not just run with it?
Water cooler talk.
Yeah.
You know, people are standing around saying, yeah, well, when the weather shakes up, this economy is headed back.
well, you know what I find, as far as in the mortgage industry, you know, so we've already established that the mortgage lenders aren't making that much money at all. They're
record low since they started keeping track.
Right. They're not approving. They're approving, you know, fewer and fewer loans as we have moved, you know, from last year into this year. That's not really going to change. Now, it'll be interesting to see, Lewis, is if when we start getting these numbers, if they stay the same with existing home sales and new home sales, if these lenders' guidelines start to open up a little bit, is there going to be any private capital that comes back to the market as far as mortgages? Are they going to start to have these programs? Now, granted, I already know that there are, you know, hedge funds and funds that are put together now where you can get stated income loans. You can get them. You can get these type of loans, but they're not favorable terms. They're going to be, you know, 30-35% down, and, you know, your interest rate might be 7%, somewhere in there, maybe high sixes.
You might as well get 10 credit cards and buy a house then.
Right. You can get those. You can get those type of loans, but with it's not going to be favorable for somebody that has a lot of money. Let's say it's a business owner that, you know, would need a stated income type of loan because they have, you know, they have tons of revenue coming in and they've got a lot of assets that they would be qualified for a stated income type of loan because, see, the stated income loan was created, Lewis, for, you know, the self-employed person, right?
There's very few of them.
Yeah, for the self-employed person. Where the stated loan went wrong was they started letting W-2 wage earners state their income, okay? That
makes no sense at all.
I never understood that. And they used to be, the underwriters back when, they used to get on a website that gave, like, the pay grade ranges for somebody's title. So if you were a superintendent, if you changed your title to like a superintendent at 7-Eleven, that would have a pay grade of something to something, right? So as long as you were stated your income within that range, the underwriter could sign off on it. So, you know, that loan essentially disappeared, but the reason why it disappeared is because the underwriting standards were ridiculous. They were so loose. Well, now we have the direct opposite. Now we have underwriting standards that are so far gone the other way that nobody can get a loan. And, you know, and like I said, there can be one little thing, one little trip hazard that takes place in the middle of a process. I've seen it day in and day out where we have people that got $1 million in the bank and they're trying to get a $500,000 loan and they're putting 50% down and they get turned down because they have a large deposit in their bank account of $10,000. Okay?
It's ridiculous.
Because they can't verify where it came from. Well, do you want them to verify $10,000? What about the other $1.5 million they have sitting there, right? And you're worried about the $10,000. It doesn't even. You can take it out. Well, no, sir, we can't take that out because we've already seen it. And once we've seen it, the guidelines say we must verify. We must account for large deposits.
So what does a guy like that do? He takes the $500,000 out of his bank account and he buys a house for cash.
Yep. That's exactly what happens.
And that means then if that guy is up against another mortgage borrower, that other mortgage guy who, let's say, makes $80,000 a year, has $50,000 in the bank, going to put 10% down, well, what do you think the seller is going to choose now? The other way, he didn't care where the mortgage came from, whether it was from a rich guy or from a regular guy. But now when the cash comes into the situation, it's going to take the cash.
Yep.
There's no contingencies.
Right. I mean, all day long that's going to be the case. And it's like, you know, we talk a lot about like how much of the overall real estate transactions, Lewis, are cash deals. And, you know, some of it has to do with, you know, obviously you can get better deals when an investor's using cash to buy properties. But the other part of it is that there's probably 50% of the people that applied for mortgages that got turned down that said, you know what, I'm screwed. I'm just going to have to use my cash. Right? So
now they're screwing not only the person who's using his cash, but they're screwing the person who might have gotten a house with a mortgage if it was mortgage against mortgage.
Right. And all the while, Lewis, that the banks are going back crying that they're not making any money on mortgages, right? They're crying about that. But in all actuality, I don't think they care. They don't care because they don't. When they want to lend something out at 4%, they'll invest in the stock market and try to make double that.
Absolutely.
Right? So
the only reason they loan money is really as a favor now, because they don't want to have bad loans, not for the 4% risk.
Correct.
And they're smart. Look, if you and I have talked about this for years now, that if you have a fixed mortgage at, let's say, 3.5%, 4% for 30 years, 10, 20, 30 years from now, the bank is a massive loser on that mortgage because there's going to be nominal price inflation.
Yep.
And when you pay your mortgage 20 years from now at today's dollar amount, it'll be probably worth, a tenth of what it's worth today.
Right.
Because to get a mortgage 20 years from now, instead of paying $2,000 a month, you might be paying $8,000 a month on the same house.
Yep.
But you're only paying the bank $2,000 a month.
Yeah, I mean,
banks don't want to make those loans.
No, they don't want to make those loans at all. I joke all the time. I was like, if somebody would find a way for me to get 30 or 50 or 60 mortgages all at 3.5%, I mean, I'd be all over it. Yeah, as would everybody else, right?
You just lock that rate in, and you're good to go.
Yeah, and just imagine long term. I mean, you've got the best in vehicles you ever needed right there. You're paying hardly any interest. Most of those you probably would have some sort of positive cash flow,
right?
Especially if you're buying in metropolitan areas.
And it would go up every year, your cash flow, but your mortgage would stay the same.
Absolutely. Yeah, I mean, your taxes and insurance, the only thing that could potentially change over that 30-year period. And, I mean, I really – and that's the one thing that is why that the rich are getting richer right now, because people's wages are not increasing right now, right? They're not going up, so it's not just like all of a sudden they're going to be able to go and afford bigger houses. The only thing that's allowing them to go and buy the bigger house right now is that their property value went up. They were able to sell, and they were able to take the equity out of that property and throw it down on a bigger house. It wasn't because they were able to qualify for more of a house. Now, I'm not going to just, paint one broad stroke. There are people out there that are still successful right now that are growing businesses the right way that do qualify for those.
Names, please.
They're few and far between. Far between. And I'm once again, I'm using an eye test on this. I know how many people I talk to on a daily basis, and I know how many people, when they work with, 2 or 3 lenders that I typically use, how many of them are getting denied. I see it.
They should not be getting denied, and this isn't some kind of civil rights rant, but by normal credit, these people should be, if they're not getting the credit, how is anyone going to get any credit?
Yep.
These are the people that have the most money and the most secure employment or the most secure businesses.
Well, and what's frustrating to me, Lewis, is that the banks are in win-win situations no matter what market we're in. Because if they're in a low interest rate environment market, they win because they don't have to loan cheap money out to everyday average people. And if it's in a higher interest rate environment, they will lend that money out. They'll change their standards, give it out and more freely because they're willing to take on that risk to make the higher risk.
Yeah, and if there's defaults, they'll have the government behind them and the Fed behind them.
Exactly. Yep. And
so if they win, they win. If they lose, they still win.
But, all the while, all the bankruptcy laws are going to be continuing to change, right? So it's going to be harder and harder for your average Joe to just go and have a Chapter 7 bankruptcy done.
Is that right? Can you give our listeners some update on? I haven't followed the bankruptcy rules in the last 5-10 years.
Well, the Chapter 7 guidelines are very specific to income restrictions, right? So you used to be able. I mean, I believe that the income threshold was much higher than what it is now. I want to say in I'm just guessing on these numbers, but I've had a few past clients that have had to go through these scenarios. Like if you're a married couple, I want to say that your income can't really exceed. I want to say it was like 90 or 100,000 combined. It was something low. Right? And so if they don't qualify for Chapter 7, it automatically throws them into a restructure or a Chapter 13. Well, what most people always want to do, they don't want to have to do a Chapter 13 because then they have to work out a plan with all their debt, all their debtors and pay it back. The Chapter 7 would essentially wipe out everything, right? So there's less people now that actually qualify for the Chapter 7.
Because of a change in the income requirements.
Because of the income requirements. And they can alter these because they obviously felt like people were gaming the system and being able to get out of these situations that they were in and just wipe everything out. So they can control that too. So the banks are the only ones that are allowed to have these billion-dollar bailouts with, and get free money. But the everyday average Joe, you're pretty much dead in the water. It's you make a bad bet or get yourself into too much
you live with it, right?
You live with it, which is what should happen.
Exactly.
It's kind of crazy. I did want to touch on one other article that I had pulled up, Lewis. It was, and this is actually it's more specific to my market, but I think that this is probably something that's taking place across a lot of the major metropolitan areas right now, where it was showing, and I believe it was in the Washington Post, it showed that about 50% of a lot of the transactions that are taking place outside of the MLS. Like either auction sites or realtors are not even listing them on the MLS because of the inventory that's there. If there's a low inventory environment, there's multiple contract situations. So obviously, you can see where there would be an interest for a realtor to do that, to try to get both sides of a transaction, right? And where are they listing these things? They're listing them. If you go on Facebook, there's a lot of these Facebook groups where it's like a conglomerate of real estate agents, like 15 to 2. On the one that I know that's in my area, it's about 2,000 agents that all list their properties on this private Facebook page that you have to request. Whoever runs the group, he has to allow you in.
Right.
When he allows you in, people put their coming soon listings on the site, right? So in my market, where the inventory is really low and everybody's kind of buying for the same property, now, let's say I have a listing, it's coming up on 2 weeks, I go on this site that's kind of, it might as well be considered an underground site. I put it on there, say I have a listing coming on in Ashland in 2 weeks. Essentially what I'm saying is, hey, do you guys have a buyer for me right now, right? Or and so who does that help? That helps the top end agents that have access to all these.
Right.
But also it hurts the general consumer again. Because
sure. Now you would think that, and there is a debate that the MLS harms the consumer because it's a monopoly, but at least it's a monopoly that's available to everyone, and consumers can go and get the same crack at the houses as they come onto the market. But if they're not even allowed to look at the houses because they're outside of the MLS and because they've already made a determination they're not allowed to buy these because these are going to be cash purchases, then you're right. If there's a housing inventory shortage, this exacerbates it. Because they'll never get to look at these houses.
Well, I got one for you. So my dad and I, obviously, I've told you, Lewis, that we buy and flip real estate. We'll do it kind of all over. We'll even go to areas that I'm familiar with. I went to school down in Ashland, which is near Richmond, Virginia, so I have a friend that's there that will send me properties all the time. His dad's a real estate agent. So there's a historical area of Richmond that actually one of my friends used to live on the street. So he sent me this property, and I'm looking at it, it was like $320,000. And I know the historic streets are probably worth about $500,000 or $600,000. Well, the agent that put this house on the market, she puts it on the market probably about a week ago. And it's on MLS. Now, typically when something goes on MLS, you can't put it on MLS unless you're able to actively show that listing. Right?
Is that right?
You can't just put it on there and say,
MLS?
hey, I'm not going to show that property.
Okay.
Well, when we called to try to get a showing, essentially, they said, we're not taking showings until April the 5th.
Why is it listed?
Yeah, why is it listed? Well, I can tell you why it's listed, because she's trying to generate, the buyer on her own. You know what I mean?
Right.
So when we get into market,
they put them on rent. They do the same thing for rents.
Oh, yes.
They show us something. This is for rent when it's not. They're trying to sell it.
Well, and I think my big picture problem is that in an environment where we already have trouble with people getting qualified, in an environment where there's already low inventory, it's making it extremely more difficult for the average, consumer to be able to find a home, right? And
so why bother?
So why bother? That's where I think, a lot of this is headed.
Culturally, it becomes, if real estate is going to be a gut-wrenching experience, prices go up, prices go down, you might as well just rent and not have to deal with that.
Right.
Or if you don't have the money, you stay with your parents.
Right, and it's so driven
and then culturally you become used to, everybody else is staying with their parents, starts to become the norm. And you defeat the whole home ownership concept.
Well, I feel like, the home ownership concept has gotten diluted, quite a bit. Now,
and the way it got diluted was by pushing it too hard.
Absolutely. I mean, and you know what? There was no reason
to mean something.
Yeah.
You save up your money and you buy a house. Not everyone should have a house. We're going to help you get one by reducing mortgage standards and giving you money to buy one.
Yeah, and everybody's always playing cheerleader. Look, prices are going up. Everybody's happy. Stock market's up. Everybody's happy. That's not what we want. We want there to just be a steady market. We don't have it. And when we have these, typically when you do the eye test on the markets and you see these crazy fluctuations in the stock market and housing prices, there's something wrong with the economy immediately, right? Like,
how can home prices and stock prices be rising when you have at best a tepid economy? They're hitting record levels. Because home prices are higher than they were back in 2005. Stock prices are all-time high.
Right, because 98% of all the money is coming from 1% of the people.
Right.
That's really the only reason.
QE creates distortions.
Yeah, and I would say to people out there that are right now actively looking or planning on selling their house in the near future, so that we're talking about really would just help you get a game plan of where you want to be, 5-7 years from now. And I think that obviously, people look short term, but I always urge people to kind of try to look to the future too, because you want to prepare yourself for the future. And if you're going to lock yourself into a low 30-year fixed mortgage, what are you going to do, 10 years from now? Or do you plan on keeping that house? Do you plan on selling that house? Because look, you're going to have, if you have a 3.5% mortgage on that house, I might not advocate you getting rid of it. And mainly because you've got a great interest rate on a property that could turn into a great. It's an asset to you.
Even though it's a liability that you have to pay, but it's an asset because it's hard to get that.
Yeah, and these are big picture, questions that I like to ask people that many people don't care about. It's just, I'm going to buy that house and I'll worry about, that house 10 years from now. Where to me, it's more critical to know what the Fed's doing right now and where our price is going to go. Because I honestly feel like the stock market's going to lose 50% of its value in the near future. Now, I don't know if near future is this year or the next year, but it's soon. It's soon. I believe it's going to all come crashing down. The same people that drove it up are going to end up shorting the market. They'll end up making money on the other side, and your average investor will lose all of it. Right?
And they'll be able to pick up selected pieces at the bottom prices because they'll still have massive cash positions.
So, and then what will happen? Home prices will go at some point will go back lower, and who's buying them at low prices again? It's the same investors that are buying them now. So yeah, it's a vicious cycle. It's a very, very vicious cycle, and unfortunately, the people at the top are going to continue to do this and manipulate.
Pump and dump. They make money on the pump. They make money on the dump.
Exactly, and the only thing that you can do as the average consumer out there that's just trying to make an educated decision is take the information that you have in front of you and make the best decision possible, but also pay attention to what's taking place short term and long term, and try to position yourself somewhere to be successful. Now, you're not going to be as successful as they are with all the cash, but if you could potentially, have an asset or two or three maybe that all has low fixed rate interest rates, and you're able to keep those properties for long term for 30 years, you're going to put yourself and your family in a better financial picture than other people.
Clearly.
I honestly see this because everybody gets really giddy about rising home prices and like, oh, look, I got $100,000 in my house. I got to do something with it, right? It's just burning a hole in their pocket, and they haven't even touched it yet. So I can promise you that the 3.5% interest rate or 4% interest rate is infinitely more important than that $100,000 sitting in your house. And it takes many people can't see that, but I promise you that when I look at these interest rates, I honestly get mad that I can't take out 20 or 30 loans right now. I do all the time because I'm like, I sure wish that I could lock myself in, long term.
Right.
Because if I had the hundreds of millions of dollars and I was able to do that, then I could set my family's future up right now. You know what I mean? I literally could if I had the wherewithal to do that. Unfortunately, I don't.
And there are people that have done that and are doing that.
Exactly, but I do have control over, the basic moves that I'm making right now and the stuff that I can control. So if I'm able to pick up another investment property at a low interest rate, then I'm going to do that. And I'm going to continue to try to do more of it until, interest rates get to a point where it doesn't make sense to me anymore. Well, Ryan, that means you're going to pay a little bit more in price. I don't care. I'm locking myself in on a low fixed rate. And see, I don't get caught up necessarily in the price like everybody else does. And this is because I have a long-term view of the economy and not a short-term. And that's one of the things working with a professional. Take the information that you're listening to on this podcast and digest it. You're not always going to, hear the information that you want to hear, but that's why we have the podcast, is to give you the good, the bad, and the ugly. Unfortunately, there's a lot more ugly than there is good right now. But that doesn't mean that you can't take advantage of the good. So, just some food for thought there, guys. But, please, if you've gotten anything beneficial out of this podcast, I recommend that you forward it and share it to other people, because, obviously helping the show grow, obviously helps me, but I just love helping other people and informing other people. Louis, you and I have been talking for, over 3 years now?
Right.
And, the people that do listen to the show, I get great, feedback that it's like, well, you guys are talking about what nobody else will. Yeah, because the media has no reason to want to pump this type of information out. It doesn't make sense for them.
Especially in the context of real estate. There are people talking about the Fed and the economy the way we discuss it, but no one really wraps it into how it impacts the real estate market.
Absolutely. And, and because everybody just thinks that it's just as simple as mortgage interest rates up or down, prices going up or down, should I buy, should I not? And it's not that simple. Especially in today's market, it's all Fed driven. It's all interest rate driven. It's all investor and cash availability. I mean, it's all these things. But knowing these things makes you a more informed buyer, which there's nothing better than a more informed buyer and seller. I can promise you that. So if you got something out of this, like I said, forward and share it. If you haven't, download and subscribe on iTunes at Real Estate 360. Louis, tell everybody where they can go to check out your weekly blog, please. The
blog is at smallgold.com, and I supplement our show by writing a blog post or two a week on the economy, the Federal Reserve, real estate, and gold and silver. So please be sure to check that out as well, and you can subscribe to smallgold.com right there on the blog post, right there on the blog.
Great. Thanks, Louis. Appreciate it.
Thanks, Ryan.
Thanks, guys, and we'll be back at you next week. Have a great week. Talk to you soon.